Hello, this is Joe Hoyle from the University of Richmond, back to talk with you about Chapter 10. By now, you've read the chapter and probably discussed Chapter 10 in your accounting classes at school. Property and equipment is a very important topic. It usually gets a lot of time in a college class. There's a lot to be covered. I hope that as you read this chapter, or as you discussed it in class, you thought about what was most important in your understanding of how financial accounting works. That you decided those things that would help you have a better understanding of the information that was conveyed in a set of financial statements. I've got my top 5 list. In fact, I talked with my wife about them at supper tonight. So let's get to it and let's see what I thought was number 5. To me, number 5 was the idea that fair value is rarely reported for property and equipment. Now, when I teach my introductory class at the university, if on the first day I walked in and said, you see land is being reported at $75,000, what do you think that means? Most of my students would think that that was the fair value of that land. That's because they really don't understand the language of accounting quite yet. Land, property, equipment, those things are almost always based on recording historical cost. So if you report land for $75,000, that's most likely what it cost the company to acquire that asset. Why don't we make more use of fair value? Well, a couple of reasons. First, unless you think the asset is going to be sold anytime soon, the fair value is really not very interesting information. It's only interesting if you're going to sell it, and land, property, equipment is rarely actually put up for sale. And second, fair value in most cases, especially cases like with property and equipment, is no more than a guess. It's an estimation. Accountants rarely like to set up financial statements on pure guesswork. They prefer objective evidence, and that isn't the case when it comes to fair value. So when you look at a set of financial statements and you're looking at property and equipment, you're probably not seeing fair value. There are a couple of times you might, but that's unlikely. It usually is based upon historic cost. For me, that was number 5. As I went through this chapter, number 4 for me was the recording of exchanges. Companies will often exchange one asset for another asset. Often they'll exchange an old asset for a newer model. How do they report those transactions? The rules here are very straightforward. Accounting is always much easier to understand when the rules are very set, and they are here. You find the book value of the asset that you give up and you take it off the books. That asset is gone. You then record the new asset at fair value. But that fair value is the fair value of the asset that you surrendered. That is your cost. That is your sacrifice, the fair value of the asset that you gave up. You only use the fair value of the asset that you received if you do not know the fair value of the assets that you gave up. Take off the book value of the old asset, put on fair value for the new asset, fair value of the assets you surrendered, and any difference is a gain or loss. That's good financial accounting reporting. When you see that, you know what's happened. For me, that was number 4. Now, let's look at number 3. Number 3 to me was the recording of impairment losses. Large companies will have many buildings, equipment, machinery, and the like. And some of it may actually have its value impaired. What do they do in those cases? When I was a student in school, my teacher said that assets of this kind are only written down if there's a permanent decline in value. But nobody could tell me at that time what we meant by permanent decline in value. And that was because the rules in those days were very vague. Well, the rules have evolved, and the rules are now better. Impairment losses are recorded if two things happen. First, you have to see if you can recover the cost of the asset. By that I mean you take the book value at the current time and you compare that to your estimation of the cash flows that that asset will generate in the future. If the book value is lower than those future cash flows, there is no impairment and you don't make any recording. If, on the other hand, the book value is greater than the total future cash flows the asset will generate, then we believe the asset is impaired. The second step then is to write that book value down to its current fair value and record the reduction as a loss. Ask yourself, is it impaired? It is if the future cash flows are below book value. If so, write the asset down from book value to fair value and record the drop as a loss. The rules, in this case, are much better now than they were when I was a student. We're moving up now to number 2. I thought that number 2 was the idea of how much does the asset cost. There's a lot in Chapter 10 about determining the cost of a property and equipment asset. You add to the asset all normal and necessary cost to get that asset into condition and position to generate revenue for you. That is its purpose. That's why you got the asset, to help generate revenue. So anything that gets you to that point should be capitalized. So as you buy an asset, or in some cases as you build an asset, any normal and necessary cost to get it in condition and position to help generate revenue should be capitalized. Because this cost is often so high for so many companies, I placed it number 2. And of course, that brings us to the number 1 most important thing in Chapter 10. As I looked at this chapter, I thought the number 1 most important thing was the complete discussion of depreciation. This is often one of the biggest expenses that any company has. And remember, depreciation is simply the allocation of the cost of plant and equipment to expense over its life. As we said in the earlier video, this is a great example of the matching principle. You take that cost and you allocate it to expense over the time the asset is helping you to generate revenue. The only real question is, how do you make the allocation? And we talked about 3 examples in this chapter. The straight line method, which gives the same allocation to each period. Accelerated depreciation, such as double declining balance, which gives a larger expense to the earlier periods. And the units of production method, which is a method based upon usage. Depreciation expense is a way to show the cost of that asset and to affect net income. Because so much of the chapter revolved around the recording and determination of depreciation, I placed it number 1. This chapter helps us understand more about financial reporting. We're taking one of the biggest assets, property and equipment, and we're getting it recorded on the financial statements. Whether it's talking about exchanges or impairment or fair value or depreciation or cost, all of this is important in establishing a good, firm knowledge of how financial statements convey information about an organization. Hope you've done well. Hope you've learned a lot about property and equipment. Keep working. You'll get there.